Good day, everyone. My name is David Williams, Executive Director of the United States Association for Energy Economics, and it's my great pleasure to welcome you today to our webinar entitled The Impact of the Coronavirus on the Oil Outlook and the U.S. Oil Industry. We're grateful to Marianne Kah from the Columbia Center on Global Energy Policy and our distinguished panelists to lead today's discussion. First, a little bit about the United States Association for Energy Economics. We are the largest affiliate of the International Association for Energy Economics and provide a forum for the exchange of ideas, issues for professionals interested in the field of energy economics. The organization produces 2 journals, a newsletter, and holds conferences and virtual presentations on the topic of energy economics. We also produce a host of other products and services that you can find on our website at usaee.org. If you're not already a member of the association, we encourage you to consider joining. A few housekeeping matters before we start today's webinar. First, this webinar is being recorded so that those that wish to view at a later date can visit our website and have access. And if you wish to ask questions, there is a Q&A button at the bottom of your Zoom screen that you can click on and have your questions sent right over to the panelists. We have allocated time at the end of this session for Q&A. And now I would like to introduce you to our moderator, Dr. Marianne Kah, Senior Research Scholar, Columbia Center on Global Energy Policy and USAEE past president. Marianne, over to you.
Great. Good morning or afternoon, as you will, and welcome to the webinar. The coronavirus, I don't have to tell anyone, has had a dramatic and unprecedented impact on the global economy and oil demand, as well as oil prices. We were seeing oil prices down to about $20 a barrel before our president tweeted some sort of agreement this morning, which I'm sure we're going to hear about, even though there's not much information yet on that. So the webinar is really going to address where we're going to go from here. I mean, despite that agreement, I would think that most of the destruction to demand is happening because of the virus itself, and this doesn't quite fix it. We are fortunate to have some of the leading experts in the world about oil markets, oil geopolitics, and the U.S. oil and gas industry. There are more complete bios on the web invitation, but I will quickly remind you of who's going to be speaking today. We have Paul Horsnell, who is the global head of commodities at Standard Chartered, and in his past, he was Assistant Director for Research at the Oxford Institute for Energy Studies. He's going to cover the global oil supply and demand trajectory and pricing. We have Bob McNally, who's the founder and president of Rapidan Energy Group, a Washington-based think tank, who specializes in energy markets, policy, and geopolitics. And we're going to ask Bob to explain President Trump, which is going to be difficult for him, but he'll give it his best shot. We have Artem Abramov, who's a partner and head of shale research at Rystad Energy, and he leads the team that's responsible for the empirical analysis of shale well production profiles, completion techniques, and economics. And he will talk mostly about the impacts of the oil price collapse on the U.S. oil and gas industry. These speakers are in very high demand, particularly now, so I thank them on behalf of the USAEE in taking the time to address our members. We will have an audience Q&A at the end of their talks, but you can queue up the questions anytime you have them in advance on the screen. So with that, let me turn it over to Paul to start.
Thank you very much, Marianne. Yes, probably the last thing a speaker needed was for Trump to do that 20 minutes before we started, but we can incorporate that. And just in the 20 minutes I've been sitting here, Brent rose $11, fell $8, and then rose 2. Now that's what we used to call noise. Some of these numbers. All the way back to kind of markets. And for that, I want to go back to the work of Paul Frankel. Now, I think there have been 3 great energy economists in history. One was Paul Frankel, one was Maury Edelman, and one was Robert Mabrow. Paul Frankel was the first of that, was writing immediately after the Second World War at a time when crude was worth nothing, and the entire game, there was no transparent market or market clearing price. The whole game was about storage. It was about moving crude around the world. It was knowing how to manage that supply chain. And the whole of his book is, I think, just an instruction manual for what traders are doing right now, explaining how regional prices affected by storage and how traders need to equalize through by moving sometimes very large quantities, the kind of market we're not used to, because we're not used to very large imbalances at the margin. We're used to prices doing the work. We're used to OPEC being there to equalize things on a longer term basis. So we do have some I think template to look at the current time, but it's from very far away, and it certainly I found reading Paul Frankel again over the past week probably more useful than anything else I've read. Just put this in kind of context and those kind of imbalances. We've been running some month by month, country by country demand forecasts, really just feeding in for each country what's the current position of the lockdown, what's the expected duration, then adjusting as things come along. And on the last iteration of that, for April, the fall in global oil demand is 18.5 million barrels a day. And that's a mind-boggling number if you thought of that at the start of the year, that demand could go through that kind of a change. And it's followed up by fairly large changes in falls in the months after. 14.9 million barrels a day decline in May. We've got 9.4 in June. And I think the risk to those numbers are probably to the downside. The danger is that the lock-ins will increase, that the that kind of fairly sharp improvement rate it turns out to be much slower. So huge demand imbalances, the kind of supply imbalance we're looking at, and this will help put perhaps Trump into a bit of context. Excess supply for April, and remember, there's not much we can do about April now. The tankers are scheduled, things have loaded. April has happened in terms of excess supply. Excess supply for April, 21.8 million barrels a day. If supply were to carry on untrammeled, we were looking for 18.3 million barrels a day across Q2, which, if you add all that up together with the March surplus, comes to 2 billion barrels. So that's sort of puts it in the context of the sort of numbers we're dealing with, and historically totally unprecedented. In terms of what Trump has just tweeted, remember, it's not a deal. He's just arranged that there will be a meeting, and he hopes the deal can be done. And the number he's put forward is 10 million, but he hopes it could be 15 million. It helps, but if we're looking at a 21 million barrel a day surplus for April, and I said that's gone, can't do anything about that. Taking 10 million certainly would bring May down to a more manageable amount, but it's still 5 million. This was a market that would crash before on supply surpluses of 2 million, 3 million. Now we're thinking of 5 million as being something relatively small and unmanageable. So lots of moving parts, but we are left there with a very large demand shock, and one which I think will get larger. In terms of that across the annual year, across the whole year, I think global oil demand will fall 5.43 million barrels a day on average across 2020. Again, as I said, downside risk, because the more that policymakers try to push the flatten the curve for coronavirus, the more they're depressing demand, obviously, and expanding that April decline through into further months. Largest demand decline for the US, got 1.91 million barrels a day decline, and again, risk very much to the downside. So historically, I think unprecedented in terms of the size of the demand shock. In terms of the supply shock, again, historically unprecedented. It's a positive supply shock for quantities, a negative one for prices. The numbers involved there are relatively small compared to those demand numbers, but again, historically large increases in supply following the breakdown of the OPEC Plus agreement. But overall, this isn't really about supply in the very short term. It is about that demand fall and the build-up of inventory. The traders trying to squirrel away barrels, very much in that kind of Paul Frankel world. And so perhaps hardly surprising that some of the regional prices now have fallen extremely low. $3 in Guernsey, North Dakota a couple of days ago. Some posted prices down to $1. Generally a lot of locations, particularly in the US, but not exclusively in the US, now looking for prompt physical prices below 10. And there's not an awful lot to be done to save that in terms of the production cuts. That will help in terms of cleaning up the surplus a little bit later on, but does leave us clearly in a position where both supply and demand are going to be experiencing some fairly significant long-term changes here. Going further forward on supply demand, at the moment, we put in a 1% allowance for loss of demand next year relative to the previous business as usual case. So that's allowing for the businesses that don't come back, the bounce back in the economy that doesn't happen. Again, I think there's a lot of downside risk to this. We may be looking at a multi-year depression demand compared to the original business as usual case. The quick snapback here doesn't look too good given the scale of some of the economic damage being done. So some of that will change, and I think demand patterns are going to change. You can see that from the way that people are working from home, the way businesses have found that traveling not at all, still they're managing to, some of them, to do some business. You just feel that there's going to be some longer term depressants on demand that will go beyond this short-term initial shock. On specific supply numbers, I'll leave our time to talk about your show in particular, but for what it's worth, and this is highly price sensitive, on our current supply demand scenario, we've got US supply falling to as low as 10.6 million barrels a day by the end of next year. I think there's probably some downside risk to that as well. So again, I don't want to understate that even if this turns out to be short and sharp in terms of getting market back to balance, if producers can come together with those kind of quantities, we're still left with a legacy of a huge amount of a surplus oil built up. So I think I'll stop there and pass it back, but to summarize on that, don't understate the demand shock. If Trump really wanted to make a headline today, he needed to say 20 million barrels, not 10 million barrels. Do you think 10 million barrels incredible to say that the day that the US president announces that he's negotiated a 10 million barrel a day cut in oil supplies, and therefore effectively joined the US up to OPEC, it's not enough? But I think that's my bottom line. It's not enough. The demand shock is too large and has too many reverberations going forward. Marianne, back to you.
Thank you very much. Very interesting. And now poor Bob is going to have to explain what's going on and why President Trump got involved in this way, when I guess there was a greater expectation that we were looking at anti-dumping things and import quotas. So Bob, please explain.
Hi, Marianne, and what an honor to be on this group with you, and thank you everybody for joining. I feel we're on the set of CNBC, so let me just, as Paul was speaking, we got the Saudi announcement, and it's a little more measured, so let me just break the news. The kingdom calls for an urgent meeting of OPEC Plus and a group of other countries with the aim of seeking a fair agreement that will restore the desired balance to the oil markets, et cetera, et cetera. So look, let's just step back for a second. And Paul really started it where this all began, and that is an unprecedented collapse in demand, almost breathtaking to even analyze. I have to go back to the simultaneous startup of the Black Giant in East Texas, Monster Field in late 1930, combined with the Depression, for a last time you've seen any kind of a twin black swan here, with a demand collapse coinciding with a supply surge. And back then it was with the absence of a swing producer, which has also been the case. I was fortunate to have been in Riyadh, in Vienna for the last OPEC meeting, and then in Riyadh right afterwards. And, I think there's a lot of conspiracy theories on what happened and so forth, but as we talk about where we are and where we're going, I think a little bit of history is important just to understand where all the capitals are. And even this statement from Saudi Arabia I just read, which is a lot more measured than President Trump's announcement of presumably 10 million barrels a day. I mean, the verbatim comment from the president, the tweet was 10 million barrels. I'm assuming he's not aggregating a lower MBD amount. Let's just assume he's saying MBD, or he meant that. Look, the OPEC Plus, which follows in the line, a long line of I think temporary cartels and producer groups, swing producers that come together in busts. The first one was the Oil Creek Association of 1861. There have been others that come together in busts and cut production. And that happened in 2016 when at $26 a barrel, President Putin had decided to call off the last endurance contest he had with Saudi Arabia just a few years ago and agree to cooperate with small cuts. But then going into March 5-6 here with the coronavirus, as Russians said, sorry, that's too big of a problem. We're simply not going to contribute 500 to 700,000 barrels a day. We didn't sign up for that much swing production. So Russia kind of just walked away. And the Saudis kind of said, well, you know what, if the Saudi doctrine since the 1980s has been, we will not cut alone. Since the 85-86 sort of surge in Saudi production, their view has been, we will not cut alone. And the Naimi corollary, former Saudi oil minister Ali Naimi in 2014 on Thanksgiving Day introduced a corollary which said the Saudi Arabia will not cut without Russia. And so without Russia, there's no swing production, and the Saudis decided to go for market share. And they're quite good at it, as we saw, and quite quick. So in my view, the Saudi view remains, and I think it's consistent with the statement I just read. They're not going to cut unless others contribute, and that includes Russia. And we see no indication yet that President Putin is willing to contribute cuts. Now, President Trump is desperate for cuts, now getting to Washington. There has been a remarkable evolution in the president's thinking about oil prices, and he has been quite candid about it. He has said, I can't believe what I'm saying, but I used to think that low oil prices were always good. He's a New Yorker. He thinks about pump prices and the perspective of the consumer. And if you read President Trump's writings, his books, his interviews, you can overlook this. Right up there after China, his boogeyman, his enemy number 2 is OPEC. But now being the father, as he would like to say, I think, of the energy renaissance and the energy revolution, U.S. becoming a net exporter, largest oil producer, suddenly it's not so cool to have crashing oil prices. And he's seeing the other side. So plan A for the White House, and I think it took a step forward today. Don't get me wrong. I think there's going to be an accelerated OPEC plus meeting. I would just be very cautious about assuming any big cuts going in of any magnitude anytime soon. So the president's plan A, if you look at the administration, their plan A was to stop the fight, if you will, between Saudi Arabia and Russia, get these folks to cut. But as Paul said, the numbers we're talking about are so large in terms of demand destruction and the rapidity of it, that any reasonable supply cut is unlikely to prevent towering surpluses, a move toward tank tops, and crude prices falling to shut-in or below levels that even shale companies need to justify for continuing completions and so forth. We're going down to single digits, if not single digits. Some people are talking about negative oil prices, as we have seen for natural gas in Texas. So look, but plan A for the administration was get the Russians and the Saudis back to the table. And it looks like we've made some progress. The president made some progress, at least in getting a meeting. But in terms of getting a buy-in, I don't think we're quite there yet. But there's plan B. And plan B is a resort, I think, to some sort of protectionism, some form of curtailment or penalty or cost onto imports. The oil industry in the United States, as it has in the past, is bombarding the administration with calls for some form of relief from imports. They range from Harold Hamm publicly calling for anti-dumping investigations. In some ways, that's the most mild remedy. That would just launch a 12-month investigative process. Hard to find Saudi Arabia and Russia guilty of anti-dumping when their lifting costs are below $10 a barrel. But that is one. I think it's a sideshow, but it's something that's being discussed. Another, more seriously and more impactfully, would be some form of import quota or tariff. This could be across-the-board quotas on imports. It could be selective quotas or restrictions on imports from bad actor countries, such as, in the view of Washington and the oil industry, Saudi Arabia and/or Russia. Actually, in the fourth quarter of last year, the United States imported more oil from Russia than Saudi Arabia. not crude oil. We get a distillate feedstock from Russia. And that's about to change as an armada of Aramco tankers is about to show up in the summer here. But Russia exports a good 600,000 to 700,000 barrels a day to the United States. Saudis have been running at about 400,000 barrels a day. Again, about to change many-fold. Also a variable import tariff, a variable price import tariff, where, say, Uncle Sam collects dollar for dollar on imported barrels below a target price, $30, $35 and so forth. So you'll see all that. And then, again, I'm so honored to be on this panel, especially with Paul Horsnell, who is such a, in addition to being a thought leader and a mentor to many of us, a historian par excellence of the oil market. And I'm sure he, like me, are taken aback, really, by the move in Texas to consider quotas in that state for the first time in 48 years. It was 48 years ago last month that Texas sort of ceased 4 decades of mandatory quotas, import cutbacks on producers. Texas, as we know, was the mother of OPEC, and I would argue, the most effective swing producer in oil market history from 1932 to 1972. Well, 2 producers have asked the Railroad Commission to dust off its old authorities, which still exist, and they exist in many other countries, by the way, states, I should say, to dust those off and impose quotas. And the producers, and Pioneer and Parsley are the producers that have requested this process, they understand that Texas is not big enough in the market. It doesn't have pricing power. What Texas does is probably just going to, any quotas would just formalize production declines that are going on anyway. But the hope is among the producers, and there's one commissioner of the 3, Sitten, who supports this, is to hope that a Texas quota, and perhaps other states, could contribute to a collective supply response, could be part of that, let's call it OPEC++, which again, Saudi Arabia has just alluded to in the statement that I just read to you. And down the road could be part of a, if not a permanent OPEC++, where Texas is showing up to meetings and agreeing to curtail production. That's very unlikely. But instead, at least part of emergency response to the current oversupply. Final point, you may ask, well, wait a minute, back in the day when Texas was cutting back, and as much as, U.S. oil states in the 1950s had 20% of global oil wellhead production off the market and spare. The Seven Sisters contributed another 15. Consider that. Where do we see anywhere where regulators in a cartel hold back 35% of global production capacity to keep prices stable? It's exactly what we saw in the 1950s when there was structural oversupply. But back then, Texas and other oil states were choking back primary drive wells, very cheap, low-cost wells and so forth, going to the Christmas tree and just turning it off, turning it back on when the conditions allowed. Shale oil, as we all know, is very different. So what I think, if there are quotas at the RRC, I think what they're thinking about is instead giving producers a couple months to adjust their completion and drilling programs, to allow the heavier decline rates to accomplish any reductions that are required under quotas. So I think that's how they're thinking of operationalizing it. With that, again, Marianne, I think I'll again thanks everybody, and thank you for inviting me on this panel. I look forward to the other contributions and the Q&A.
Thank you, Bob. Now we're going to turn to the impact on the U.S. Oil industry. And Rystad has collected an enormous amount of data about production, margins, and a number of characteristics about the U.S. oil industry. So we are very fortunate to have Artem here to talk about what he's seeing. So take it away, Artem.
Thank you, Marianne, and hello, everyone. Let me just share my screen with you to make sure you see it. Can you just confirm that you can see my slides now, Marianne?
I was muted, but yes, I can see them.
Yes. Okay, excellent. Yeah, so what I wanted to do, I wanted just to take everyone, very quickly through some of the implications of this very uncertain market environment and very challenging market environment indeed for the US oil and gas. And I really would like to start on a positive note, look a little bit at the recent history. The US light oil production grew at quite an unprecedented rate over the last 3 years. It basically doubled between late 2016 and 2019. And a lot of people were talking about some form of slowdown in the industry last year. To some extent, we saw this slowdown happening on the activity side. Demand for some services, the well counts decelerated, especially in the second half of the year. But when we look at production, we hardly see this slowdown. It was more or less the continuation of the same linear growth trend from late 2017 and 2018. Another thing which is quite important when we move into this downturn is that business model for the public US shale producers changed dramatically. So we really went from multi-year period of systematic overspend, very aggressive activity and production expansion, into the new phase with more disciplined and balanced capital programs. So CapEx for the industry have actually been declining already for 5 consecutive quarters. And if you look at cash from operations, in the ideal world, it should follow the production expansion. But last year, there were some challenges and bottlenecks related to gas and energy prices, which affected economics of producers negatively. Another thing which really differentiates this downturn from the previous down cycle from 2015 and 16 is all leverage positions and basically debt positions of shale E&Ps. If you just assume for a second that every single shale player will pay back all the debt maturities, which are basically upcoming in the next 5-6 years, then they would actually need to cover $20 billion per year in the total payments on the maturing debt and interests. And the challenge which companies are facing now is that their equity investors largely expect them to continue reducing their leverage ratios. Some companies, they don't have this problem. They have very strong balance sheets, but in many cases, it's not only about covering the interest, it's also about actually being unable to roll over the debt. So what it means in practice that the industry this time has to react much faster compared to how quickly they adjusted their activity in 2015 and 2016. So we were monitoring all the CapEx announcements, all the changes in company plans over the last three weeks. Already in the first week after the oil price crash, 10 companies reduced their full year capital guidance for 2020 by like $3.6 billion. The following week, another $7.5 billion was removed from the market. And the last week, we had few more producers coming out with $6 billion revision. So combined, they already adjusted their full year guidance for 2020 by 33% down, which basically implies almost 60 to 65% reduction in the running rate of activity, the number of rigs which we have today, the number of frac spreads from the level where we are today, basically to the bottom, which I expect will be reached at some point in late Q3. When we look at actual activity, we already see some of these trends, some of these declines happening. For example, the rig counts, they're already rolling over. They're declining from the peak, which we had in mid-March. We're already below the bottom, which we reached in late 2019 last time. And these declines are really happening across all basins in the Permian, but also in all other liquid basins, Scoop and Stack, Eagle Ford, Bakken, DJ Basin. We're seeing the declines everywhere. Looking at fracking activity, assuming that all operators stay committed to free cash flow generation and their free cash flow targets, which is more or less what they're doing now, we do expect around 40% decline in fracking activity already this year. And this is for $30 per barrel WTI environment. So essentially activity is going all the way back to the level where it was in 2016 in terms of the well counts. If low price environment persists, then the next year we'll see less than 4,000 wells fracked in the whole country. Almost 70-75% decline from the activity level we had in 2018. And of course, production, due to very steep decline rates on the base production, it cannot be maintained with such steep decline in the activity. If we stay in $20 to $30 WTI environments, we will be seeing almost the natural decline, even without any sensitivity, any shut-ins on already producing wells. So this year, between Q4 19 and Q4 20, we already would expect a decline of anywhere between 1 and 1.8 million barrels a day if oil prices trade in $20 to $30 WTI range. Another topic, and Paul already discussed it very much in detail, we also do our own modeling on the demand, coronavirus impact on the demand. We heard the number of 18.5 million barrels a day. We basically arrived to pretty much very similar figure for April in our latest base case. If we average the coronavirus impact across the whole 2020, we are definitely seeing more than 5 million barrels a day of global liquid demand lost. And there is definitely more downside than the upside to this current, to the latest projections. If some measures are not as effective as we hope, there is also a risk of the second wave of coronavirus spread in some countries. So these things might actually delay the recovery. But even with these latest base case, we are seeing global liquid stock builds of the magnitude of 20 million barrels a day in quarter 2 2020. So even if 10 million barrels a day are cut immediately, we'll still see very much oversupplied market. So something else has to happen on the supply side. Essentially, market forces have to result in shut-ins across maybe many regions globally. And the most expensive, or in some cases, the most flexible supply sources, they have to contribute to the global supply-demand balances. Canada, oil sands projects in Canada is one of these supply sources, which is at serious risk now, and we're already seeing some shut-ins. When it comes to the US, there are two conceptually different supply sources. A lot of people talk about marginal or so-called stripper wells, the wells which produce less than 10 barrels of oil per day. And when you go from $50 to $10 per barrel wellhead prices, actually 60% of these stripper wells cannot even cover the cash costs, essentially lease operating expenses, production taxes, and royalties, primarily because they're very old and mature, and they have very high water cuts. So disposal costs, they're very significant in the context of total lease operating expenses structure. But in practice, this supply source is not very flexible, as some people think. Many stripper wells, they're not connected to the pipelines. Essentially, trucks just come once in a while to basically take the crude, and it takes up to 9-10 months for these marginal wells producing 2-3 barrels a day to actually reach 100% utilization of the tank storage at the least. The typical tank storage is 500 to 800 barrels. So essentially, they are not really exposed to the spot markets. So operators of these stripper wells, which are largely small private operators, they can wait for many months before they actually deactivate these stripper wells. And we haven't seen too much sensitivity of stripper well supply during the previous downturn as well. So the real response, if it gets really bad, if WTI prices go into mid-teens, the real response will have to come from modern light oil wells. And if you look at the light blue line on these charts, it shows the real kind of cash cost level for all major counties in different unconventional basins in the US. So most of these points, they're slightly below $10 per barrel in wellhead terms. So as soon as WTI is around $15 per barrel, and we see it for several days, so maybe a couple of weeks, we'll start seeing massive shut-ins of light oil production across the whole country. In reality, small producers in all basins, they will be affected disproportionately, simply because they don't have firm transportation commitments, and pipeline owners, they are already asking producers to cut production voluntarily because they've seen some refinery shut-ins, they've seen the lack of storage in some cases, and this process gets kind of tougher and tougher. So 3-4 weeks down the road, if you don't really see significant improvement in the supply-demand balances, some of these pipelines will simply stop taking any crude on walk-in or spot capacity, which will basically facilitate all these shut-ins among smaller companies. And of course, we did a lot of modeling and history matching to the historical number of Chapter 11 cases we have seen in the US E&P industry. And it doesn't have to develop in exactly this manner, but this is just to illustrate the magnitude of potential increase in the number of bankruptcies across the US oil and gas industry. And this is only E&Ps, not including any service companies, some midstream players. So even in $30 environment, we would expect the new all-time high, actually, number of Chapter 11 cases already in 2020. So it will be higher than in 2016 if such low price environment persists. And there are thousands of small producers in the country. Many of them don't have debt in the capital structure, but many of them also have. So when you take into account all these producers, majority of them cannot really service their debt if you take WTI prices really low. And finally, I just would like to finish on a positive note. Just before this oil price crash, one of the main topics for the industry was ESG and flaring, which happens in the Permian Basin. And now we need to take into account that the most important driver of the flaring is the activity level, the number of completions, the number of new wells which the industry delivers every month, every quarter. As activity is declining very rapidly now in the Permian Basin, already in Q2, the flaring of gas, both in absolute terms and also relative to the oil production, will decline sharply. So essentially, we do expect the emission intensity in the Permian to reduce, to decline to the level which we haven't seen since 2012, emissions driven by flaring exclusively, already by the end of this year. So even though producers are struggling now with their economics and profits, at least they will be able to include some very nice emission-related charts in their presentations and sustainability reports this year. So this is everything I had in my presentation. So I think I will now pass it back to Marianne.
Thank you so much for, again, an excellent presentation. A number of questions have come in, and some of them were sent in before we saw the action by President Trump this morning. So some of them have actually been answered. There's been a number of questions about whether the Russians and Saudis will get together and meet and discuss this, whether the US will implement protectionist measures. I think that Bob has covered that. One question that has come in doesn't it make sense for Russia to want a deal given that their storage is completely full along the Druzhba pipeline? And I guess I'll direct that to Bob. Can you hear me, Bob? Or Paul, whoever.
Yes, no, sorry about that. Well, let Paul, but on the Druzhba, you can, yeah, yes, it is in Putin's interest to do a deal. Our information was President Putin expected that the price of Urals, the grade that matters for the Russians mostly, would not fall below $30 a barrel. I think they stress test their expectations of a dissolution of OPEC Plus on that. And they thought that with Urals at 30 and a war chest and a sovereign wealth fund that's been built up and a flexible ruble, they could tough it out. But Urals, last time I checked, was I think below $20 a barrel. And so as it goes lower and storage fills up, and the Saudis have done a pretty good job at almost shutting the Russians out of seaborne trade, President Putin has his own interests in now, I think, wanting to come back to the table, as he did, again, in February 2016, when the Saudis launched this sort of blitzkrieg against Russia. It was with the memory, the recent memory of Russia having to, be taught once earlier what the implications were of no swing producer and walking away from collective cuts. So the answer is yes. But the question really is, and again, I welcome Paul and others' views on this and yours, Marianne. I do think the Saudis are going to insist that Russia make large contributions to what now we can talk about 10 million barrels a day, and that's, I think, from all producers. But even a 4 to 5 million barrel a day cut by OPEC Plus, which would be sort of in line with past heavy rounds of cuts in 97, 98, 2008, 2009. But a 4 to 5 million barrel a day OPEC Plus cut, where Saudi Arabia went below 9, I think they would ask the Russians to pony up a good 500,000 barrels a day or more of real cuts. And the question is whether Russia's really willing to do that. I think that's an open question.
Good. Excellent.
Marianne, can I just add to that?
Yes, please.
Yeah, just add, I think it's, well, some of it's already coming through on news now, but the Saudi shopping list is going to be quite a long one. They will demand full cooperation from the US, which is going to be a big one. So that's back onto Bob's Texas Railroad Commission. They're back in business. So is Trump really prepared to sign up the US to effectively join OPEC plus with output cuts? They want Canada in there. They want Mexico in there. They want Brazil in there. Brazil already cutting, so that's easy. And I think what's on the table from Saudi Arabia is nothing more than a cut below 9 million barrels a day. So that would be cutting 3.5 million to where they're just moving up from, but really nothing more than that. Both Russia and Saudi Arabia confirmed that this 10 million figure, where did it come from? I mean, they've agreed to eventually have a talk, to eventually have cuts, assuming that all of these other countries sign up first. They haven't agreed on a number. And I think that's why the market has retraced very, very heavily, just literally while we've been talking. Brent is now sort of 28, it was 36. And I think Paul von Moore saying that this just looks like Trump, dare I say it, shooting from the hip, but the number, maybe it was 10 million barrels total. I mean, that's, who knows, but rather than 10 million a day. But that's, you know, this is not a done deal. And I think the more you look at it from a Saudi perspective, once you've started this, you've got to carry it through. You cannot stop here. First, it's pointless. The train for April has already crashed. We've already got that nightmare coming. You know, storage will be filling up, and I'll quickly say something about storage in a minute because I saw there was another question on storage. Let's have the shakeout. You know, let's really sort of have non-OPEC through and make sure then that these, because it's very easy at this point for countries to that. But I think Saudi Arabia will really want to see the money first. They really want to have that one tied down. So this, I think it's a lot less than meets the eye. But again, we're one tweet away from all of that being thrown over. In terms of storage, and again, just to come back on to how big a crash this could be, I mentioned a number earlier that you know, adding up those excess supplies to the end of June, it's 2 billion. When you start adding, somebody's asked how much spare storage is there. Most estimates, depending on definitions and depending on you know, whether you put in strategic or not and other bits and pieces, roughly in the range of 1.2 to 1.6 billion. So on those numbers I went through, storage fills. So something then has to come off involuntarily. And I think we're already starting to see that. 100,000 here, 200,000 in Brazil, bits and pieces coming through in the US oil patch. But I don't think we are saved from that sort of hard stop as in sometime towards the end of May, perhaps even in mid-May. So lots of moving parts, but we probably shouldn't let the one tweet hijack the overall agenda. It still looks pretty bleak out there for the next couple of months.
So does anyone want to take the question of what are the consequences for the US and global economy if prices were to stay at a very low level, and let's say $30 a barrel for the medium term? Any takers there?
Well, I can take it just by saying that they're not going to stay at these, well, and lower levels. They're not sustainable. You know, you can't have an entire industry not covering its operational costs. So prices will rise. I think if anything, the question for the medium term is how far are they going to rise? How much supply is going to be permanently impaired? How many of these wells that are shut in don't actually come back to at least with their former vigor? You know, how much more damage is done? And precisely what does the what does OPEC plus want if it ever came into existence? So I don't think the prices are sustainable. We are looking for them back. But the immediate impact on the economy, there are no positives for economies through low oil prices at these levels, because the reason we've got these prices is because of coronavirus, which is a generalized demand shock across the entire economy. So if your economy is not doing anything, it doesn't really matter what price oil or gasoline is. I haven't moved my car for 2 weeks now. It hasn't, not depressing oil demand because it's electric, but all the same, you can see that the impact on the economy is far greater than any kind of offset you can get from low oil prices. From the point of view of the oil producers, again, it's this double shock. You've got a demand shock across the entire economy coming in through coronavirus, and the large falls in GDP arising from that, and they are substantial. And then you've got an additional shock coming through the reduction in revenues. So in that sense, we know it's not sustainable. It's going to have to shake out. But the short-term impact and medium-term impact, I think, is fairly traumatic for both producers and consumers.
Right. In fact, I would say I'm somewhat familiar with the literature for the US economy, And what it really shows is that any benefit you would have gotten on the consumer side from having more disposable income to spend on other things, you don't get in the coronavirus because people are unemployed and they're not traveling. So they don't really get the savings on lower gasoline prices.
Right.
And whatever they would have gotten would have been offset by reduced capital investment by the oil and gas industry, since the US is now a major producer. Okay, let's go to the next question. Would filling the vacant storage in the US Strategic Petroleum Reserve make a significant difference in the supply-demand dilemma? Bob, you want to take that one?
Sure. Look, as we're going to tank tops, every little bit helps. So the 77 million barrels of vacant SPR capacity amounts to what we estimate about roughly 8% of global crude oil spare capacity, if you will, or empty capacity. So, you know, every vessel, every container, every tub, every bathtub, everything helps when we're filling every container on the planet with oil. Certainly, I think it makes sense from a national security and a budgetary perspective to acquire barrels at low prices and to halt, and if I may, I think it was irresponsible sales ordered by Congress of SPR crude. So if anything good has happened here, it's that at least Congress has stopped the sales. And I think the administration is going to go forward in filling. Now, as I said earlier, the Democrats insisted on some green, environmental proposals and concessions in return for a $3 billion appropriation to just buy the oil. DOE says, well, we just because we don't have the money, we could do it anyway. There's $4 billion in a green car program left over from President Obama. We can use that. I think there's a legal debate about whether DOE can do that. But for the time being, again, DOE is choosing a legally safer way, which is to offer the industry just to use the capacity through an exchange program. So does it really make a difference given the kind of numbers that we've been talking about today in terms of a 20 plus million barrel a day demand collapse we have quarter to quarter 3.4 million barrel a day supply surge? No, it's about 3 days of the demand destruction in April is what we calculate in terms of what that 77 million barrels. And that's assuming it happened quickly, which I'm not sure it will.
Thank you, Bob. We have a question for Artem. Most advanced nations do not flare gas. Should the Texas Railroad Commission put limits on natural gas flaring? Or will the market take care of it? I'm not sure how the market takes care of it, but.
I guess it would be, first of all, fair to say that most nations, which are whenever they were in early days of oil field development, they flared a lot of gas, and we still have a lot of flaring globally. It's not really, if you look at amount of gas flared per barrel of oil produced in some of these growing basins globally, Permian actually doesn't look that bad in the global context. But on the potential for additional regulations from the Texas Railroad Commission, I personally do not believe, I do not think that's the best way to approach the problem. I think it is really about better communication between E&Ps and midstream companies, especially when it comes to the project planning, the timing of well completions and the governing lines. This is where the industry has actually to work together. Different participants have to work together in order to ensure that the timelines of these different projects are standardized. So I support the theory that that's the best way to reduce the flaring. And even without oil price crash, this year we could have seen substantial reduction in the flare intensity in the Permian. We actually already saw this in Q4 last year, and so also January, February data shows significant improvement before oil price crash.
Thank you, Artem. The next question is, the Rystad demand slide seems to suggest demand is back to the baseline forecast towards the end of 2020. Do the rest of the panelists agree or disagree with that?
So was it back to the pre-coronavirus baseline?
That was, I could probably comment on this first, because when I was presenting this, I basically said clearly that this is just one of the scenarios with, effective prevention, where we believe that all the measures, the lockdowns and travel restrictions which the countries implement now, they will prove to be effective, and then we do expect the demand recovery towards the pre-coronavirus levels by the end of this year. But there is more downside risk to these numbers than the upside, the way we see it today.
So do you agree, disagree, Paul?
I think I'd have to disagree. But as I said, I think there are some longer term effects that depress demand through next year. And I was thinking, we took it down 1 million for next year for those longer term effects. I'm going to think that's probably not enough. I think given the scale of the economic crisis, to get back to business as usual by the end of December, it's not going to happen. Then you factor in the things which will never be the same. And there are some things there that will never be the same. The airlines, it's never going to be the same. The way in which people working patterns, it's not going to be the same. It's going to be very hard to put this back together. So I think returning back to them is perhaps possible for some Asian economies. You could get back to something that looks like that, helped by obviously a lot of economic stimulus coming in behind. But any scenario where you get demand back to anything that looked like business as usual quickly, it's not proper demand. It's pumped up by government stimulus. It's not, it's air. It's not anything which I think is sustainable. So now I'm much, much more negative on the long-term demand. I think we've got much more of a problem here in the longer term than we first thought. We thought this was a Q2 issue, and then we thought it might creep a little bit into Q3. Now it's beginning to look like something which will have some echoes that continue a bit longer. Great for energy economists. We're going to have something to write about for the next 20 years. I mean, people of my generation, and I always were rather jealous of those who had 86 to write all those books on for 20 years. And it's our 1986, 20 years worth of publications, Bob. So
very good.
That's great. Here's a question about whether ESG or environmental social governance focus leaves the investors, or do they continue where they left off? And is there a delay in electric vehicle penetration as a result of this downturn?
Happy to take a stab at that one. Our review at Rapidan going into and before this crisis is that consensus, and when I say consensus, I mean IEA, EIA, OPEC, and balances published by major oil companies. Consensus estimates of global oil demand growth in this decade reflect a wishful thinking about the pace of EV penetration and super efficient ICE cars or gasoline fueled cars. So I will just stipulate that we were skeptical that global oil demand growth in a world growing at 3.5% without recessions, which is the basic assumptions in these modeling forecasts, unlikely in practice, but we're just talking about forecasts here, that oil demand was going to range between 400,000 barrels a day a year, EIA, and about 900,000 barrels a day. So less than 1% oil demand growth in a world growing at 3.5%. The only way that could happen is if indeed EVs were to proliferate and existing gasoline cars, the fleet, become much more efficient. We were always skeptical about the role that policy would play in driving that, the speed of that. Not that it's not going to happen eventually, but the speed of it. President Trump just weakened President Obama's fuel economy standards. They had called for a 5% fleet efficiency. They're now calling for 1.5%. And the way we read those standards, they weren't going to achieve the peak and collapse in gasoline demand that EIA is forecasting anyway. China started backing away from EVs. They've been plummeting subsidies since last summer, and they're in complete free fall. And those are the two biggest countries. Europe is a little more serious about it. Europe has very stringent fuel economy regulations. Not clear they will have a profitable car sector, but Europe will go further than China and the United States. So I will say before all this, we thought the big variant perception we had with consensus was about the pace of demand growth. Now, in my view, the collapse in oil prices, the economic damage will further set back policies aimed at driving EV penetration and higher fuel economy standards in cars. And consumers, having had a taste now of, in the United States, $2 gasoline or less, will be less willing to make that decision to buy that more expensive electric vehicle. But I will say this, and perhaps a little more atypically and more on the, let's say, optimistic or other side of the energy transition debate. You know, electricity and alcohol have been competing with oil since the very first days of the transportation market, modern transportation market. The first passenger vehicles were actually subways, electric subways. And so one of the reasons that the car industry, one of the reasons, not the main one, but one of the reasons that the car industry went with oil over batteries and electricity and oil, which again were quite widely experimented with and used in the late 1800s and early 1900s, is because oil was thought to be plentiful and stably priced. Rockefeller's success at stabilizing the price of kerosene in the late 1800s helped convince the auto industry, that plus Spindletop, that there was not only plenty of oil, but that it was reasonably and stably priced. Now, in the near term, I think, again, this price bust will set back EV purchases and policies aimed at that. And however, if the market gets accustomed to an oil market where there's no effective swing producer, and over a 5 to 7 year cycles, we should expect, instead of the anchored long-term oil prices, which we have since 1932, instead, though, get used to a sort of a permanent Space Mountain roller coaster ride, where oil prices are going to range between shut-in prices and demand destruction well into the triple digits. Then I think you will see actually a faster move towards decarbonization, a search for alternatives to oil in transportation. And like the last big shift from 5 millennia on horses to cars, it will not be driven by government policy, Paris agreements, or fuel economy standards. It will be driven by private capital, private investors, private innovators, desperately looking for a way off of Space Mountain. So in a way, perpetual boom bust oil prices, which may be a longer legacy of this pandemic. The pandemic will fade, but we may not have an effective swing producer after all this. And if we don't, we're on boom bust oil prices for the indefinite future. And that, I think, poses the biggest threat to oil and transportation, albeit one that is likely to materialize later than the current balances, consensus forming balances assume.
Thank you, Bob. And I wanted to check with you, Paul, since you have more of a European perspective. Do you agree with what Bob thinks, that government regulation is not going to drive this, but market swings will drive the shift to EVs? And have they been delayed or postponed because of the coronavirus?
I think I agree with Bob. I think probably the momentum in Europe, we've got so much tax anyway that the momentum probably continues. I mean, one thing we can be pretty sure is that a step change in oil prices will not be fed through, ultimately through to the consumer. On the ESG part, yeah, I think investors are still going to be very much on ESG. I mean, investors fell out of love with the oil sector, particularly the US shale producers, for other reasons than ESG. I mean, it was an industry which has taken a huge amount of capital and returned nothing at all. And I think this latest incident, another case of where might on an accelerated pace. So, do you want to invest in a sector that does this? Probably not anyway. Do you want a return from it? Yes. Is it going to give you a return? No. And then ESG is then another layering on top of that, which within your overall fund, again, more so in Europe, but it is growing very quickly in the US. These ESG elements matter. If you look through the major shale producers' Q1 presentations, they've all got at least one page on ESG, if not 2 or 3, because they know that's what major investors are looking for. So it's another, I think, reason why the sector is going to be carrying this weight continuing forward. That's not going to roll back. I think the low prices, I agree with Bob on they're certainly going to impact on consumer choices, but I think government policy is now sort of trembling on, particularly outside the US, towards
Okay, I think we have time for one last question, and that is, when demand finally does return, even if we don't think it's going to return to where it was in 2021 or 2022, will the supplies be available? Will the supply response be fast enough to keep up with demand, or will we go through a period of higher oil prices?
I think we go through what exactly as Bob described. I think we're going through boom bust cycles. The highs are going to be higher than they would have been. The lows are going to be lower than they would have been. And that's really going to be one of the major questions through the next 3 months, is how much of this supply impairment will be permanent. Anyway, in the next 5 years, and producers may say, well, just speed it up, just let it go. If its operating cost is 30 and I'm getting 15, what's the point in going through that argument? An extended period, let's just bring it off early. So I think the whole shape of supply would have been changed. But the more important is very much as Bob described, what's going to emerge at the end? Is it OPEC plus plus? Is it OPEC plus? Will the Texan flag be flying in OPEC HQ? I mean, where precisely does some of the supply side management finish? And I suspect it's going to end up looking a bit like OPEC plus. I think the US stuff will fall away. I think we get into Q3 when again those surpluses then become a bit more manageable. We're through the worst of this corona shock. This is the worst time ever to start talking about longer term supply arrangements. This is an accident that's just going to happen next couple of months. Talk about this and do something else. The moment all Trump is doing is destabilizing the market. What we actually need now is a period of very low prices to get people shut in. We don't need producers having these days of hope that say, hey, look, I don't have to. Looks will fall away and we will get this move back.
Great. Well, we are out of time, and I wanted to have everyone virtually thank our 3 speakers who did a wonderful job, particularly under duress when some major event happened 20 minutes before we started this webinar. So, and thank the USAEE and any IAEE members for joining us this morning.
Thank you very much.
Thank you.
Thank you.